Southeast Radio's Business Matters with Karl Fitzpatrick.
Southeast Radio.
Well, impact investments are a growing phenomenon which has grabbed the attention of investors throughout the world. But what is it, and does it deliver a return? Niall Dineen from Appian Asset Management joins me on the phone now to discuss this in greater detail. Niall, we'll be discussing impact investments and Appian's Impact Fund. But first, perhaps you can provide us with an overview of Appian Asset Management.
Yes, Appian Asset Management is an independent Irish-owned asset manager. We've been around since 2003, and we focus on a range of products which are multi-asset products, which go back to being launched in 2005, and we have equity products that have been around for the last decade.
So talk to us about Appian's client portfolio.
Appian manages about 350 million. That's split across a range of clients, be that private clients, charities. We would also have some religious orders. We would have, and we would have corporates. So it's a wide range of clients. Now,
the reason I've asked you to join us on this morning's programme is to discuss ethical investment. So what is it all about?
I think that's a fantastic question for today, Karl, because this question of ethical or environmental or ESG investing is really what the whole industry is talking about today. And if we think about historically what ethical investing was, it was actually about investing but screening out areas of the market that you don't want to invest in. Today, when people think about ethical investing or responsible investing, we genuinely believe that people are looking for something that's going to have a positive impact on society. So for us at Appian, ethical, responsible or impact investing, whatever name you want to put on it, is no longer about just not doing bad stuff. It's actually about doing good stuff and investing in areas of the market that will have a positive impact on society.
So specifically, what impact areas are popular from an ethical investment perspective today?
The areas that we see the real opportunities are in the area of resource efficiency. So that would be sort of clean energy systems or even electric buses and areas like that. Then there's also recycling. We think that's going to be a huge positive investment theme going forward. And then there's other ones like water sustainability and food sustainability. And also maybe social improvement, investing behind companies that are going to improve society going forward.
So what criteria do you have in place when you're assessing investment opportunities?
Genuinely, our approach to this is that we will own about 30 to 35 individual securities. So from that perspective, it's up to us as portfolio managers to go and meet these companies, understand their culture, and understand where they're having a real impact on a particular area. So what we've done is we've set up the team that focuses on 5 impact areas, and the companies have to have a genuine impact in one of these teams.
And have you witnessed a shift in the type of investors that are now looking at good, ethically responsible investments?
Within our client base, we're definitely seeing that just with everybody is starting to think about it. And before, years ago, I would have been a skeptic about this area and said that people are only going to be concerned about financial returns. But I think people today think about themselves, they think about the world that they're leaving behind for the children, and I think everybody is now looking for the double impact from their investments, which is, yes, it's financial return, but it's also to have a positive impact on society and the environment.
So talk to us about the Appian Impact Fund and how it operates.
Yeah, the Appian Impact Fund, is first of all, it's a multi-asset fund. So it invests in equities, but it also invests in other asset classes such as forestry and renewable infrastructure. So this is a fund that because it's a multi-asset fund, it's targeting a return per annum of about 4 to 5%. It's aiming to achieve that 4 to 5% return by investing in equities and other investments that will have a positive impact on the environment.
And how does your business model work? Are you actively out there looking for companies to invest in, or are they coming knocking on your door?
I think the reality is that in the investment world, you can't sit and wait for someone to knock at your door. So so we have a proactive approach to going out and meeting companies, and we will have people on the ground in the UK and in France over the next 6 weeks. So our approach is to go out, meet companies, and unearth these opportunities that actually fit into our investment philosophy and process.
What is your strategy in that respect?
I think our strategy is is to go out and actually meet companies that fulfill an investment criteria of being good quality companies that that have a track record of producing profits, turning those profits into dividends. And our belief is that if we can find companies that can pay good dividends, grow those dividends, and at the same time, but the business model is underneath one of these impact areas, then that's going to result in the double bottom line for investors.
And how do you go about identifying such companies?
We have a database of over 8,000 companies. So our starting point is to screen our database for companies which are of high quality. That means that they have business models that generate good cash flow returns on their capital, and they have strong balance sheets. And secondly, we look for companies that have good value characteristics, i.e. they have good dividend yields, they have low price earnings ratios. And once we have a set of companies that fulfill those criteria, our next step is to go and find which one of them are actually generating those profits from our impact teams.
And what projects has the Impact Fund facilitated to date?
Starting from an equity perspective, we've been invested in a lot of companies that have been benefiting from this evolution away from plastic into other forms of packaging. So I think a lot of our companies that we're in, are making glass or they're making cartons, and they're actually benefiting as everybody moves away from plastic and actually decides to use something else. We have other companies that have been investing in the actual recycling. They've been building the recycling plants. And then, if I'm thinking about outside our equity space, we have a big investment in forestry. And forestry is a wonderful example of an investment that will produce a double bottom line. Because yes, it's important for taking the carbon out of the atmosphere, but number two, it actually produces a nice steady return for investors.
And just in relation to that, how do the returns compare between ethical investments and those of mainstream investments?
My belief is that at the moment we're at the beginning of almost a new type of investing, which is the impact investing. And so really we have to look forward and have a think as to is there going to be a return difference between investing in these really positive areas or investing in say, at an extreme example, in oil stock. As a standard, then my belief is that the returns are not going to be dissimilar over time. But I think you will get more in the old industries. I think more of your return will come from the actual dividend, whereas in these new impact areas, I think they're going to be more growth driven.
And is there any risk that ethical or impact investment could just be a fad?
I think there's a huge risk here, and from two perspectives. I think from number one, I think the financial industry as a whole is doing a lot of greenwashing. So I think it's actually dressing up a lot of old strategies and it's calling them impact responsible or ESG, the bandwagon. But I don't think the actual funds are any different to the normal funds. So there's a risk here that that we get a big backlash against the industry, and at that point in time, this type of investment might take a step back. The other risk to this type of investing, from what I've seen personally, is that a lot of people who are trying to do genuine impact investing end up almost leaving valuation aside, and they end up buying companies that are just really, really expensive.
And for investors listening to this morning's show that might be concerned about this greenwashing, where the traditional companies are just putting a layer over them to make them look like they're ethical investments, how can these investors tell the difference?
It's a very good question. From an investment perspective, we're in a world today where a lot of investments have moved towards index-type products. And index-type products, are probably going to own 100, 200 equities. My belief is that, that a genuine impact investor will not be owning 100, 200 equities. So a genuine impact fund, in my mind, will only have between 30 to 40 stocks. And what I would say to anybody who's interested in investing in this area is actually ask the fund manager for a list of the equities they own and then actually spend some time looking at the companies. And
do you ever see a scenario whereby authentic ethical investments will surpass less responsible investments?
I think that that over the next couple of decades, there's a new economy going to emerge, and the building blocks of the old economy, which have been on fossil fuels, are going to be replaced by something different, and that's especially within Europe, where there's going to be 20 to 30 trillion of an economy emerge behind these new environmental themes. So, and these are going to be higher growth areas. So I don't think that the production of oil is going to disappear tomorrow morning. I don't think we're all going to be driving electric cars. But I think from an investment perspective, the opportunities for investing from a positive perspective are going to increase over time.
The coronavirus has dominated the headlines for the past few weeks. But from an economic perspective, how has this affected the stock markets?
I think stock markets got scared by the coronavirus at the end of January, and I think since then equity markets have bounced back strongly because the market has been focusing on two issues. Number one, that the rate of growth in the coronavirus is slowing, so therefore the market has come to the conclusion that it's just going to disappear over time like SARS did. And number two, the market is focused on the idea that the Chinese will stimulate their economy, so the economy is going to come through strong in the second half of the year. And this, along with central banks then on hold because of a bit of economic weakness, means that equity markets might actually get a positive boost from the coronavirus.
Well, if you've just tuned in, that was Niall Dineen from Appian Asset Management, and I would like to thank Niall for sharing his insights into this growing investment phenomenon.
Southeast Radio's Business Matters with Karl Fitzpatrick.